What's really good about this growth, Carl? It's both consumers and it's businesses, as evidenced by durable goods last Friday. So this is a really nice story in the near term that we're looking at.
You got a tight, red-hot labor market.
Yep.
You got inflation today at 6-year highs at 2.3. What makes you think the Fed doesn't want to at least make a stand and say we're on the case, despite what happened on Friday? And
so 2% is their target, Carl, right? So I think in order for them to become restrictive, so instead of going 3 or 4 times a year, go 6 to 8 times a year, they're going to have to see a sustained inflation expectation that is so much further than what they think. They're on it. A lot of people are saying they probably shouldn't even be going with their target of 2%, but they're on this pace to normalize things because they started at 0 and they got to get to normal.
Mark, some people are looking at what generally happens with the S&P in the last 4 months of the year. I think each of the last 9 years, you've at least seen a 1% gain, and in some cases a double-digit gain in the last 4 months. Could this year be a repeat?
Yeah, look, I think this is going to be the 5th straight month of positive returns. So the market's been moving in the right direction. A lot of investors have been on vacation and they missed this run up. If we're looking at what ends the bull market, everything I'm looking at is telling me that this market has more room to run. If I look at the fundamentals, you just touched on it earlier, they're absolutely stellar. Everyone thought Q1 was going to peak in earnings. We've accelerated past that in Q2. We've also seen very, very healthy top line growth. You've seen positive comments coming out of management teams. You've seen an explosion in capital expenditure spending of 24% year over year, which tells me management teams are quite confident in the outlook. So the fundamentals are stellar. And when you look at sentiment in the market, we are nowhere near euphoria, which typically comes at a market peak. I think in part because of concerns around trade. And for now, they've only been concerns. And because of that, it's helped that sentiment stay quite subdued. In fact, fund managers still have above average cash levels on the sidelines while the market continues to run. So I think we have a healthy backdrop heading into the back half of the year here. But I do think at this point in the cycle, you do want to move up the quality spectrum, focus more on larger cap companies with good, clean balance sheets and higher quality companies. And one point I'd like to make, though, is there's been a lot of concern around trade tensions, et cetera. But this year, you've seen the best performing factor out there has been companies that have been seeing their earnings revisions moving up quite aggressively. So rolling up your sleeves and doing your homework has been paying off for investors. So I think it's a great environment for looking at single stocks and doing your homework.
So, Phil, then what do you make of the groups that are not at record highs and have just not participated as much in this rally? Automakers, casino stocks, home builders. Do you buy them on their recent weakness, or are they flashing some sort of concern?
Yeah, it's not a warning signal, Sarah. I think a lot of it has to do with the interest rate move and the pro-cyclical sectors. Tech is a sector that we do really like. Why do we like tech? Because companies are starting to spend. And J.P. Morgan recently did a survey, and they said to chief information officers around the country, are you going to expand your IT budget given the current economic backdrop? Many said yes, 67%. Only 12 said no, right? So that is a near-term tailwind. Now, it may not be sustainable, just like earnings this year may not be sustainable because we're not going to get another tax reform.
So you're saying
this year.
Invest with the companies that are spending on their businesses?
Invest with the companies that are spending on their businesses, yes.
Is that a theme that you like, Mark? And if so, where do you see the opportunities?
Well, I think if you look at the first half of the year, tech was responsible for about 98% of the performance. You're starting to see a broadening out of sector performance. And I think there's a lot of attractive sectors at this point. If you look at healthcare, for example, it's still trading at a discount to the market, and yet they're continuing to deliver the goods quarter after quarter. You're seeing great earnings out of healthcare, which is a cheap sector. Industrial, so we pointed to CapEx and tech spending. Well, we're also seeing some brick and mortar pickup, some shovel pickup. You're seeing energy CapEx start to pick up. I think that benefits industrials. And everyone thinks of industrials as a very cyclical sector, but in fact, it's one of the highest quality sectors. You're seeing a lot of earnings stability within industrials broadly.